Futures Market and FTSE. This is higher, but still we are talking about a leverage effect, because the difference between the shape and the slope of those curves is quite high. Okay, this market used to be like this at all. This market used to have this curve as even higher than that one. In previous studies, I didn't do this myself, but I read many academic articles who proves that. I told you, if you need further information of this, just send me an email. I can send you lots and lots of materials on that. Okay?
Sorry.
Yes.
Sorry, what's the scale of the x-axis? What are we looking at there? Is that percentage change or
this one?
Yeah, so like the 0 to 25 on
no, this is those are percentage change, percentage point. This is the time calculated as lagged observation. It means you, the volatility is calculated every 25 observation. Okay, it takes the mean of that observation, and then it calculates it again 20 observation, 15 observation, 10 observation, 5 observation. It combines them together and it creates the chart. Okay, it's just the time is always the same, 2007, 2010. Okay, it's always the same. You don't have to worry about it.
And you're using daily data? I'm
using daily data.
25 days, 20 days. Sampling the market.
Obviously, yeah, we're talking about 20 days. In the case of in the case of daily data, obviously. Residuals again. Abnormal returns here, abnormal returns there. As you said, we make money if you are on the right side of the market, obviously, and you have to know if the market is leveraged or not. Otherwise, you're going to lose a lot. This is a lovely chart that that I don't know why it's not going to come up. It was the VIX, and I wanted to show you the difference between the value that I've got using stochastic volatility. Here is about 1.5%. You see here the peak. Here's about 5.5% FTSE100. Sorry, about 2.5% to 6%. About 6.5%. Volatility, the VIX market for a volatility index was in that lovely chart that I don't know why it's not going to come up. It doesn't come up. It was about 80%. Was something like that. Okay, just see my was something over there. Was about 80%. The difference is the volatility index once again is calculated using prices and not returns. It uses prices but not returns. Bid price, ask price, high and lows. That's the way in which it's calculated. The next, yes.
Sorry, could you just go back a couple of slides to the euro? You know when you mentioned the following slide, sorry. You mentioned about the volatility about being symmetrical models. Would that suggest any sort of anything about the trend in terms of if it's a sideways trend or?
It confirms the trend. When a market is basically symmetric, when the volatility is symmetric in the market, it confirms the trend. If I perform this calculation in a symmetric market, okay, and I know that market is symmetric, and there is a positive shocks in the market, it just confirms me the trend or a reversal. That's the way in which you use it. But I wanted to talk about trading strategies using this technique, but I will be doing that in another presentation because it takes too much.
Vito?
Yes?
I apologise if we covered this. Is there any way that we could use this kind of study intraday for intraday?
Yeah, of course you can. I want to once again show that now. It was an intraday trading strategy which combines asymmetric volatility with a market profile. I don't know, probably you came across these things. We will talk about this in a further presentation, but you can use basically this strategy with everything. It doesn't matter which asset you're trading, option, futures, spot market, whatever you're trading, you can use the same strategy. It's an intraday. Well, I prefer to use that intraday, but it works much better in my opinion. But you can use that even on position trader could use that. but I prefer that for intraday market. Anyway, we'll talk about this later. This is what I was referring to before. This is how the crude oil futures market used to be. You see the difference? This is how the financial crisis literally reshaped the market. This is the crude oil futures market over the last 10 years. You see, volatility rose much more. Those are positive or negative news hitting the market. Positive news.
Would you call it symmetric or slightly?
No, this is an inverted leverage effect. A leverage effect is volatility rise when price drops. When it's the way around, it's inverted leverage effect. Okay? You are probably the first person I talked. This is what I found in my dissertation, which is going to be published, by the way. Yes, I'm a bit posh now, but I know I'm quite 700 pages more, guys. It's a lot. It's a lot of work. And that's what I found out. Okay, this is an inverted leverage effect in the market, and this is what used to be. I just quickly go back to the crude oil futures market. The other one. Look now. This is how the financial crisis literally reshaped the market. That's why I'm telling you, if you're trading futures, if you're trading options, or it doesn't matter which asset you're trading now, when there's a positive shock, be careful to place your targets. Okay, don't go too far away, because I think that at least now we can't really talk about a full recovery in the market. I would expect maybe something better about June or July. Hopefully I will show you another time this calculation. We'll see, we can do a comparison before and later, but at the moment I'm not really confident that there's a very full recovery, especially because as economists likes to say, I'm a former economist, fundamentals do not look good.
Peter?
Yes.
Is this kind of behaviour other downturns?
Yes, absolutely, yes.
So this is something that just naturally occurs?
Yeah, the problem is the magnitude. In other crises, we never had. I will do this. This comparison. But in other crises, we never touched the bottom here. Okay, volatility during positive, when a positive shock used to hit the market, wasn't roughly zero. Okay, it was something here, but wasn't that low. I mean, investors were more confident in the market than now. That's what used to happen in other downturns.
So what's changed?
What's changed? This is the worst crisis ever. Yes.
On your leverage point, do these curves mean that leverage has come out of the market? Is it indicating perhaps there isn't as much leverage in the market as there was during that enormous downturn?
No, it means that in this moment, leverage is much stronger in the market, because as I said, leverage effect is the volatility rise when price drops. In this case, when there's a negative shock, the volatility rise much more. It means that in this moment, at least in this market, the leverage effect is much stronger than what it used to be before. Okay?
The leverage effect has got nothing to do with leverage as in debt.
Sorry, I misunderstood the question then.
What I was thinking of leverage in its normal sense of the word. You borrowed money.
Oh, debt equity. No. We're talking about leverage effect because this market are leveraged, okay? But no. We're talking about asymmetric volatility in this case. But in the case of what you were referring to, I don't know. I have to be honest. I don't know. When it comes to debt equity ratio, I don't know about it.
I'm still not clear about this x-axis.
Yes.
It's a measurement of news. Is that what you're saying?
Yes. This
on the left, positive.
This is time, okay?
So how do you measure that? What do you actually measure? What does number 10 on that x-axis mean? What is that?
This is time in the sense that every single 10 days the model automatically calculates the volatility. Okay, it basically takes the time frame, it divides it